establishing a basic self-directed IRA. Remember that the second slide in there after recession investing comment was, self-directed IRA is not a legally defined term. So what I told you is, in a basic transaction, all we're going to do is establish an account that with a custodian allows self-direction. When we started getting into this business, we thought we wanted to be a custodian, a trust company. That's basically a bank. You looked at what was going on and the industry and the opportunities there, and that looked pretty attractive to us. Then we started working with a company called IRA Services out of the Bay Area. That's who our custodian is for most all of our accounts. And the reason we work with them, a variety of reasons. One, they're good to work with. Two, they work well with checkbook IRAs. Three, their fee is very, very easy to take. $75 base fee. If we're talking about checkbook IRA, additional $10 quarterly. So $115 a year is what the custodial fee. If you're talking about a basic account and they own the asset, it's going to be $75 plus $19 quarterly. They don't charge you based upon the size of your retirement account. So I've got clients that we've moved from other custodians where they're paying thousands of dollars a year to a plan that they're paying $150 a year.
You said they own the asset. What do you mean by that?
Well, I'll tell you in a second. So that's all right.
I'm just kidding.
No, because I mean they're the custodian of this thing. So we'll talk about that. But I don't. Custodians that charge based upon the value of your account, I have difficulty with because now they're adverse to you. They're arguing it's worth one thing, you're arguing it's worth the other, and that's not a good situation. I've got one client that bought a note pre-market collapse for like $1 million. He thinks it's worth nothing today. The custodian's arguing it's worth $1 million. That's not okay. So IRA Services doesn't do that. But we'll work with whoever you want to work with. Whoever, if you're happy with the custodian, we're going to work with your custodian as long as they'll work with us. But really, we've got a 2-page application. The copy of it in this packet, I actually don't believe there is. But the application really just asks for your information, beneficiary information, account information, and what you want to invest in. It'll ask you for a couple of names. Actually, there is an application you're looking at anyway back here.
It's in the.
It is in there. Okay. It was at least it was in yours. Anyway, we'll see it in some of the others. There. Barbara just didn't get one.
You're referring to this?
Yes. Maybe there's one. You've got one too. So you can see it's very basic information. If you're doing a checkbook IRA, we're going to want to know a couple of prospective names for the limited liability companies. But really, we're going to take that information, and we're then going to take and fill out a half-dozen forms that allow us to establish the account. One of those forms is a transfer authorization form, which allows a new custodian to go to your current custodian and ask for the money. So it's really an easy process to get the thing set up. You don't need us to do this. I mean, you can do it. You can go online. Any of those custodians got forms you can fill out if you want to do that. But if you want us to do it, we charge $430. That includes the account establishment fee, and it covers the first year's base fee. So we're getting a few $100 to fill out the forms. But a basic self-directed IRA, what will happen, back to Duke's question, is a basic account, the custodian owns the asset. So if we're talking about a real estate investment, if we're working with IRA Services, the deed's going to read IRA Services, FBO, your name, IRA number, whatever it might be. That's a deeded owner. So when you're making an investment, from the deal's inception, you need to do it in the plan's name. You can't, we know the contracts in this state are assignable. We know all the purchase sale agreements include assignment provisions, but you can't use that. You can't personally tie up a property and assign it over to your plan. That's a prohibited transaction. The idea is the plan's benefiting by you having taken the property off the market. Now, I'm splitting hairs. I mean, if you have a problem with that, you'd have to be audited by somebody that knows what they're doing, makes a problem, blah, blah, blah. It's probably not going to happen. Okay, but our position is don't give it the opportunity. So from the deal's inception, you're doing it in the plan's name. If you've got a basic account, what you're going to do, you might be signing it. You're going to sign that purchase-sale agreement on behalf of the plan. What do you do with the earnest money? The earnest money has to come from the custodian. So if we're using a basic self-directed IRA, if you're a broker writing this deal, you're going to ask for some additional time. You're also going to state in there that this purchase is subject to the custodian's approval of this investment. Because if you don't put that in there, and you agreed to pay some earnest money, and the custodian says no, now you've got a problem.
How much time do you have to allow for that?
Well, depends on the custodian. Some of them will say, well, we've got a 24-hour turnaround. I wouldn't bank on that. I'd ask for more time. So a basic account, figure you're going to need a couple days to get the approval. The custodian's not going to decide whether the investment is a good investment. They're going to decide whether it's a qualifying investment. So is it, something that looks funny? Are you buying from yourself? Are you buying from, your parents? Something like that. That's what they're going to look at. Or, gee, it's a Sun River property. What are you going to do with it? That type of thing.
Is it fair to say that the custodian is basically just setting up a reporting structure?
Yeah, they're a disinterested third party that's there to keep you on the straight and narrow. Yeah.
And would provide
annual reporting.
to the IRS.
Yeah, exactly.
Okay.
And they're FDIC insured. I mean, it's like a bank. The money's there, the title's there. So, most of the accounts in this world are these basic self-directed accounts. If you're going to buy a piece of dirt, I'm going to say this account's going to work just fine. If you want to go buy a bank-owned property, an auction property, you want to buy a rental house and manage it, it's not going to work very well. Because back to the comment on the plumber. Tenant calls up, boom, I've got a problem, I need a plumber. You call up the plumber probably wants to get paid. Using the structure, how do you get the plumber paid? You have to submit the bill to the custodian will then pay that bill. You can't pay the bill. So, writing the offer, it's cumbersome, and it takes some time. They're the owner, but it works great. I mean, passive investments, you want to buy a note, this would be just fine because they're basically just going to receive the payments off that note. That works just fine for us. So passive investments and basic accounts, fine. You want to buy gold, a lot of the custodians will have gold custodial accounts. This will work just fine for that. The money's going to, or the the trust company's going to have the gold there. If you want to put it in your house, it's not going to be okay. So, cost-wise, very reasonable. Basic transaction, passive investments works great. Yes.
Would it work for tax liens?
Yeah. You submit the investment to the custodian upon their approval by the lien. So, most of our people end up with what's called a checkbook IRA. So, what we just talked about is this step here, from these accounts to the custodian. All right? And then we stop. The custodian was going to buy the property, the tax lien, whatever it might be. A checkbook IRA, as that money's moving across, we're going to create a limited liability company. The limited liability company's operating agreement's IRA specific. It's got all the different rules, everything in place to keep you, if you read it and follow it, go in the right direction. So instead of the custodian buying that tax lien directly, what's going to happen is, as soon as we've gotten the LLC together, we're going to get you the articles of organization, the tax ID number, the operating agreement. You're going to go to the bank of your choice. I gave you an example of Bank of Oswego earlier. I don't think we have any clients with accounts there right now, but it'll happen. And what will happen, as soon as you got that account open, it's a manager-managed limited liability company. The member of it is going to be the custodian once again. The manager of that LLC is you. Or can be you, wouldn't have to be you. But typically it's the IRA owner. So the member of the LLC will be IRA Services FBO, your retirement account. The manager is you, so you're going to establish that account at the bank. As soon as you've got that, you're going to get us the account number. We then direct the custodian to make the investment. The investment they make is in the membership of the LLC. Now they're done. The custodian's out of the picture. For you to buy the property, you just negotiate the purchase of that property in the LLC's name. You write a check for the earnest money, you write a check to close the property, the deed's in the LLC's name. All the income off the property goes in the LLC, and the expenses paid out. You call the plumber, give the plumber the debit card off the LLC's account, write a check to pay for it, whatever it needs to happen.
I'm assuming this is what they do.
Yes. His is actually more complicated because we did one for him, one for his wife, and then when we picked up that second property, we created another LLC. So what happened in this gentleman's situation was he bought one building outright, kicking off tremendous cash flow. Okay? He's got additional funds. He wants to go out and buy a new property. This new property is leveraged. So how do we cover a multi-million-dollar property's debt service if it goes dark? Bank wants to make sure they're okay, right? So what we did in that situation is created another limited liability company that had both his plan and his wife's plan as members. And we still have a problem because we use all the money to buy. Where's the money come from for the shortfall? So what we did is we ended up having the other property contributed to the LLC as well. So now the cash flow off that second property covers any potential shortfall if there was to become one. So we've got both plans in there. Typically, we would have had both plans receive membership interest according to the cash contributions. But in that situation, we had one IRA come in, receive membership attributable to its checkbook IRA's contribution of cash. The other checkbook IRA came in, received membership interest attributable to its cash contribution and the equity in the other property.
Thank you.
Sure. So back to the question was asked earlier. Who can be a member of this LLC? Who do you want to have as a member of the LLC?
Including yourself.
Exactly. So the question is, do you want to be a member of the LLC or do you want to be a tenancy in common owner? And there's different theories on what's right. If we sell the property in the future, you individually are going to have tax exposure. The retirement account doesn't. So TIC ownership, maybe you do an exchange. If it's TIC ownership, you just do an exchange and the LLC doesn't. If you're a member of the LLC, now we just do an exchange for the LLC.
If you form the LLC, the IRA LLC, can you then take on a partner for cash influx at all?
Yeah.
Or you can.
Yeah, but it's a very good question in another term. We have two different, so remember disqualified parties? You, your spouse, kids, grandparents, so on and so forth. If we have two disqualified members in there, you cannot transact with a disqualified party. So if we've got two disqualified members, we've got a disqualified entity. You could not make future contributions to that entity. You could not put additional money in because that would be a transaction between disqualified parties. Therefore, a prohibited transaction. So when we put a multi-member LLC together with disqualified members, we need to overfund the LLC to make sure we've got enough for the purchase and enough to cover any potential shortfall in the future.
That's a new partner.
Yeah.
Your brother. A money partner.
Yeah, your brother, your sister, whatever, yeah. Yeah, that would be fine.
They can't be related, can it?
Well, if brothers and sisters are okay. That's what's really screwy about the retirement world. Siblings are okay. Up or down or not. Side to side are. It must have been something to do with the lawyers that were putting this together. They must have, liked their siblings. So this is, what people really pay us for is figuring out structuring ownership. I mean, a lot of these things. How to own this thing, what's going to be the best way to do it. And in his situation, we really looked at, okay, if we did it TIC-wise, how do we do it? TIC-wise, we could make some headway with contributions, but so little that it was just a flash in the bucket, so we couldn't do that. And that's why we ended up structuring it the way we did. So Usually what will happen, if people come in, a husband and wife come in, for example, and say they want to do checkbook IRAs, if they're young and they're making additional contributions, they want to be able to maintain their ability to put money into this thing, we'll do 2. If they are older and they're not concerned about additional contributions, then we'll do 1 with both of them as members. The difference cost-wise, a basic transaction, $430. One of these we charge $2,900 for a single member LLC. Your ongoing costs with a basic account, like I said, are roughly $150 a year. A checkbook IRA, you're looking at less from the custodial side. You're looking at $75 and $10 quarterly, so $115 a year per account. So each person that's got an IRA is going to have that. Or if you have a traditional and a Roth, you can have 115 times 2. So if we've got a client that's got a Roth and a traditional, and they want to combine them into this, now we've got an LLC with 2 disqualified members because the traditional is also disqualified from the Roth. We can combine them, but then it's a static entity. So on top of the custodial cost, you're going to have the state of Oregon one's $100. If you want a registered agent for the LLC, which you as an Oregon resident with an Oregon LLC, you can do it yourself, but if you want that done, it's $125. IRA Services requires 1 other fee. They don't require a fee, but they require a third-party review of the LLC annually. And that can be done by your attorney, your accountant, or we as the organizer. If you want us to do it, we charge $125. So you're still looking, under $500 a year to take care of this thing. If it's a multi-member LLC, be aware you're going to have a tax return for it. The single member is just, totally
You're looking
transparent.
at $2,900 regardless of the size.
Yeah.
That's to set up the LLC?
Correct.
And then all of the other fees combined roughly $500 a year.
Yeah, shouldn't be any. It should be less than that, but at worst case.
Is the LLC specific IRA type
Yes.
LLC? It's not. Okay.
Well, it's an LLC that's registered through normal routes, but the operating agreement is IRA specific.
Okay.
Yeah. So the upside of this is immediacy. You can do what you want when you want. You need to do it. The downside is you want to torpedo your account. You've got the ability to. So anytime you write a check, you need to make sure that it's something that's real. If you need money for something, you can't just put it in. Honestly, whether you have a checkbook IRA or a basic IRA, if you buy an income property, you've got the ability to, cover the plumber. If you were going to abuse it, you could abuse it either way. But as far as money coming out, I would never ever want to see a check between you and this LLC, ever, for anything. So this you just make sure that every time you pull that checkbook out, that it's for something to do with that IRA. That has to be a legitimate expense that's being taken care of. Anything that's generated by that property is, once again, the IRAs. And I think the best way for you to think about it, when you fill out that application, we discourage any reference to retirement account, IRA, or your name when you're coming up with LLCs, because we want it totally clear that it's not you. And we have people who come in and say, look, I need additional income this year, so I want to buy this apartment building. Well, you can buy the apartment building, but you're not going to get the income. Is there a way to get the income? Yes. Take it as a distribution. But it's not yours. So to take a distribution, what happens? So just as the money flows from here through the custodian to the LLC, you take a distribution, it's going to go from the LLC back through the custodian and then to you. Everything has to flow through the gatekeeper, that custodian.
So,
Right.
so if you buy this outright and you've got rental income streaming into it,
Yep.
what do you do with that cash?
It's just all growing tax deferred.
But
Or tax free with Roth.
At some point,
It could,
right.
well, you can,
But
you
I'm saying,
can,
but it's sitting there in cash.
no, but you could buy stocks. I mean, it's not.
So you can use that cash.
Yeah, that's
to
the
buy
thing.
Different. Okay.
Don't
No, that answers it.
and then don't think of it this way. You're not pulling money out of your plan.
No.
So everything you have, everything you own today, you can still own. You can fund we could fund this custodial account. You've got Apple stock and you love Apple. Fund this account with the Apple stock, in-kind contribution. You can use the Apple stock to buy the membership in the LLC. So, you know, you have choice. It's not all or nothing. And you know, we have people, if this is not an LLC with disqualified members, you can just, we have people that have accounts where they're swept quarterly and the money from the income property goes right back to their stockbrokers. You know, so it all depends what you want to do. Or you open a trading account with the LLC, in the LLC's name. And the money that's sitting in the LLC account, you can buy CDs or money market savings, whatever you want there.
IRA LLC.
Yeah.
Okay.
Yeah. So this
you could
LLC.
stockpile and then reinvest into another property.
Yeah, exactly.
And you wouldn't have any tax gain on it.
It's there if you
But
want it
it'll
there.
still be under that same name.
Correct.
Right.
It's no different than if your IRA is paying out dividends on stocks that you own.
Right.
It just goes right back into that account.
So, like I said earlier, the easiest way to look at it is you're not pulling it out of your plan. You're changing the custodian, that's it. Every investment you own today, you can still own. The money that's sitting there monthly that's piling up in that account can be used in any way any other IRA can use it. You can go buy more property, buy notes, buy stocks, whatever you want to do.
Let's just say that you had $1 million in an IRA account right now, and it was cash and equities, and you wanted to buy $500,000 worth of real estate. Your preference might be not to have to borrow against it,
Yeah.
pay cash. Would it be best to take that entire $1 million and put it into the new IRA LLC, and then just use 500 of it to buy real estate, and then you can use a portion of it to buy stocks? You know, you're pointing out that you can do a private loan on it.
If it's a single member LLC, I just say leave what you want where it is and move only what you want to use.
Only what you want.
Yeah. If it's a multi-member with disqualified members, then you're going to want to move it all, and then you can establish a trading account in the LLC's name. So it's really just a question of what you want to have there for reserves. And if it's a single member LLC, money can go in and out all the time, it doesn't matter. If it's a multi-member with disqualified members, now the money can't go in and out very easily.
So there are additional fees pulling that remaining $500,000 out and putting it in.
So with a basic account, every time you make an investment, it's going to cost roughly $75. You want a check, it's $25. You wire funds, it's going to be $35, so on and so forth. You know, you've probably experienced, what have you purchased with your self-directed account?
Just set it up.
Yeah.
Just looking at tax liens right now.
Yeah. So, you know, really the question, but you've looked at the fee schedule, and, you know, that's what they're going to charge, you know, somewhere in there. Which it takes a long time to add up to $2,900. But, you know, the difference is, the reason people like checkbooks is just the ability to manage the property, and if you need to buy something now, you don't have to get anyone's permission, you write a check to do it. That's why they do it. But you don't need it for, like a tax lien, you make that investment, you don't need a checkbook, because you're going to buy the lien's going to do whatever it's going to do.
Would there be any advantage, say that hypothetically you were looking at maybe a $300,000 to $400,000 inheritance. Would you put that first in some sort of a self-directed IRA and then transfer to an LLC? Or could you do the new IRA?
I would put it in the retirement account. If you want to combine that money with your plan to go buy something, we can just buy. You can buy tenancy in common, or you can buy into the LLC that then buys together. But you know,
I was
I
thinking
wouldn't.
that there's someone you could say your inheritance tax.
No, I mean you're stuck sort of. I mean, because the maximum contribution, if it was a SEP IRA, you're looking at $50,000 a year. You know, you can't put it all in there. And really, you know, like I said, by putting it in there, then you're giving up everything. You know, probably better off just talking to your family lawyers and seeing what kind of other opportunities you've got there, charitable remainder trusts or other things like that.
So if we've got this set up here, and I was still working, could I add money
Yeah.
to that, just
Exactly.
like I could normally add?
Yes.
So that would be actually the only transaction you could do is the legal limit.
Contributions.
That contribution.
Yeah.
Okay. So that doesn't change.
No, nothing changes. It's the same account you have today. The only thing that's changed is the
So in
custodian.
effect, I could move it lock, stock, and barrel, just as it is,
Yeah.
over into this.
Yeah.
Okay.
Move all of it.
But then
move
just
what?
have, right, just have more flexibility of what.
Exactly. All you're doing is changing the way you can invest it.
But your recommendation is you don't typically move it all, you try to.
Most of our people, what will happen is if it's a single member, they'll move a little bit, get their feet wet, and they say, gee, you know, I like this, and they'll move it all.
So you're over 70 and a half, and you've got required
Minimum distributions.
Right. And it'll be based on,
The value of what that account is. So every year, what the custodian is going to require is a valuation of what, if we're talking a checkbook IRA, what the LLC has, any cash, any investments it might have. Could have stocks, could have real estate. The real estate.
we left 500 over here,
Yep.
and only transferred 500 into that.
Yep. So each custodian is going to be looking at the RMDs for what they've got.
It'll be roughly 4% off of the total.
RMDs meaning.
Required minimum distribution. So that is going to, and the valuation for that is going to be custodial based. I mean, I haven't talked to a custodian yet that requires an appraisal to be done annually for that. Okay? They'll, you know, a professional opinion of value will suffice.
I get that request.
Yeah.
Yeah.